Today, the money supply. The DFA daily to the 30th of April 2020. Hello again, I'm Martin North from Digital Finance Analytics. Welcome to the latest post covering finance and prod news with a distinctively Australian flavour. The RBA and APRA both released their credit data for March today, and there were some pretty shocking movements which reflect only the very early stages of the virus impacting the economy. Looking at the APRA data first, total credit for home loan lending rose overall by just $193 million, up 0.1%. And that's the smallest rise for many months and reflects all of the banks or ADIs in Australia. Within that, lending for owner occupation rose $2.3 billion to $1.1 trillion, up 0.21%, while lending for investors fell 0.33%, down $2.1 billion to $0.6 trillion. Investment mortgages fell to 36.8% of all loans and continues to track lower. This is a combination of more households paying down and slowing new loans. The monthly trends are also tracking lower. And looking at the individual players, we see some different outcomes, with Macquarie still growing their owner-occupier and investment portfolios, while the majors are shrinking their investment portfolios while expanding owner-occupation loans. And we include a selection from the long list. The standout is ME Bank, who dropped the value of both their owner-occupied and investor lending. Now, of course, the usual caveats apply. This is based on data as received by APRA and may not be complete. Turning to the RBA data, the monthly trends shows a large spike in business lending in March as firms drew down on their existing credit lines. Business rose 2.9%, while personal credit fell 1.4%. Owner-occupied loans rose 0.5% and investor loans fell 0.1%. The March data represents the largest monthly rise in credit across the private sector since December 2007, which was before the GFC. And the annual rate of business credit moved up to 6.3%. Lending for owner-occupied borrowers sat at 5.2% annualised, while investment lending was at 0.4%. And personal credit was down 6.5%. Ahead, the impact of the economic slowdown will continue to hit the credit numbers. Some businesses will start to cut costs and reduce inventory, which may reduce their need for credit, while JobKeeper payments will start to flow, but not until May. So we should expect to see more business lending in April. House purchases have slowed to a crawl, so demand for new mortgages will be off, although refinancing to lower rate products is likely to continue. And finally, it's worth noting the jump in the money supply. As a result of the various schemes launched, growth in M3 was 2.6% and strongly maps to the increase in business loans. Banks will benefit, of course, from higher interest charges as a result. And big news from the Reserve Bank in New Zealand today, as they've decided to remove the mortgage loan-to-value restrictions for 12 months. LVR restrictions were imposed as a counter-cyclical macroprudential financial stability tool back in October 2013. LVR restrictions have been effective in supporting financial system stability during the upswing in the credit and housing cycles since the introduction of the restrictions back in 2013. By significantly improving the equity position of mortgage borrowers, it is likely that a significantly smaller number of borrowers will have to sell their house or default on their mortgage as a result of the current economic shock. And the current economic conditions resulting from the virus crisis has led to the Reserve Bank now removing these restrictions, given the counter-cyclical nature of the LVR policy. The decision was made to ensure, they say, LVR restrictions don't have an undue impact on borrowers or lenders as part of the mortgage deferral scheme implemented in response to the pandemic. The Reserve Bank's decision was made in line with its financial stability mandate. The bank reached its conclusion after reviewing a regulatory impact assessment and robust feedback received from submitters over the consultation period, Deputy Governor and General Manager of Financial Stability Jeff Bascard says. Although the consultation period was short by the Reserve Bank's typical standards, this was necessary to respond swiftly to an unprecedented set of economic events. The feedback raised a number of valid points and concerns which were all carefully considered. Views on the proposals were mixed, reflecting both the costs and the benefits of borrowing restrictions. Some submitters recognised that removing the restrictions might allow more first-time buyers to purchase a home. All locally incorporated banks who responded were in favour of removing LVR restrictions, noting this will allow them to support customers through the impact of the virus. Of those submitters who were against the removal of the LVR policy, many were concerned about potential adverse impacts on financial stability, such as the risk of bank failure. And they also noted that the economy has weakened and job security has reduced, and the ability for people to service a mortgage will likely decline in the coming months. Given the current uncertainty around the economic outlook, the Reserve Bank considers that it is unlikely that banks will weaken lending standards to high-risk borrowers. The more likely risk is that banks are overly cautious with lending to credit-worthy borrowers, Mr. Bascard said. The regulatory impact assessment concludes that removing LVRs now does not weaken the resilience of the system. Rather, removing LVR restrictions now supports financial stability by removing one potential obstacle to the flow of credit in the economy, helping to soften the downturn. Mr. Bascard said the action will also avoid any uncertainty around the implications of LVR limits from the mortgage deferral scheme. It's important banks continue to provide support to credit-worthy borrowers during these extraordinary times. The decision is effective as at 1 May, and the change will be made via a change in bank conditions of registration. And the Reserve Bank, they said, will monitor lending activity and feedback from retail banks over the next 12 months as the economic impact of the pandemic becomes clearer. While we've eased the restrictions completely for the next 12 months, we will review the most appropriate settings for LVRs in a year's time. And back in Australia, another bank today shared their pain with ANZ declaring a statutory profit after tax for the half year ended the 31st of March 2020 of $1.55 billion, but down 51% on the prior comparable period. This decline was driven primarily by credit impairment charges of $1.674 billion that included increased credit reserves for COVID-19 impacts of $1.031 billion. The valuation of investments in Asian associates was impaired by $815 million, largely due to the impact COVID-19 is having in those markets. And cash profits for its continuing operations was $1.41 billion, down 60% from the prior comparable period. Cash earnings per share decreased 60% to 50 cents. Entering the crisis with a strong capital position, ANZ's Common Equity Tier 1 ratio is 10.8%, as at the 31st of March 2020. The return on equity decreased to 4.7%, and ANZ's board also determined it will defer its decision on the 2020 interim dividend until there is greater clarity regarding the economic impact of COVID-19. ANZ Chairman David Gonski said, "This decision is not about our current financial position, and ANZ has not received any concerns from APRA regarding our level of capital." The board agrees with the regulator's guidance that deferring a decision on the 2020 interim dividend is prudent given the present economic uncertainty, and that making a decision at this time would not have been appropriate. This is a very difficult decision, and the board considered all options available as we understand the impact this will have on those shareholders who rely on dividends, Mr. Gonski said. The board will carefully consider all factors over the coming months and continue to assess the evolving situation, including the severity of community lockdowns, before determining a final position on the interim dividend. and ANZ will provide an update as part of a trading update in August in conjunction with release of its Pillar 3 update. From a customer support perspective, he said, we are already assisting 180,000 customers with deferrals on loan payments, and we also provided $16 billion in additional lending mainly to our long-term investment-grade institutional customers to support them through COVID-19. This unparalleled level of customer support is ultimately in the long-term interest of all stakeholders, including investors. And more bad property news from The Guardian today. Renters bail out and sales plummet as the coronavirus hits the property market. The crisis is having a devastating impact on the Australian property market, with sales down by hundreds of millions of dollars and tenants handing back the keys because they can no longer afford their rent. Sales values have dropped 85% in Melbourne in the past 8 weeks, according to the figures released on Tuesday, equating to a loss of $524 million compared with the same period last year. In Sydney, sales were down 79%, a loss of $454 million. Westpac gave a gloomy outlook on Tuesday when it announced a $1.6 billion hit to its balance sheet from the virus as customers struggled to meet their loan repayments. It followed NAB's worst-case prediction of a 32% fall in prices in the next 2 years. The Frontier UNSW figures, which are derived from publicly available sources such as Domain and realestate.com, chime with a similarly drastic picture in the big city rental markets as coronavirus continues to wreak havoc on the economy. Across all capital cities, rental asking prices fell 3.1% in the past week and 2.5% in the past month, according to SQM research. In Sydney, rents were off 3.8% in the past week and 5.2% in the past month, while Melbourne was down 2.5% and 2.6% respectively. But they mask huge falls in the plushier areas, such as Sydney's eastern suburbs, where house rents are down 10%, and the CBD when they're off by 17%. The president of the Property Owners Association of New South Wales, John Gilmovich, said the rental market was very challenging in Sydney's inner suburbs. In a nutshell, 10% of the rental book is vacant, he said. Some tenants have just bailed out. They've broken their leases and handed back the keys saying they just can't pay. Others have seen their leases expire and not renewed. The under 40s especially are moving back to live with mum and dad. And he confirmed rents had dropped at least 10% and in some areas as much as 15%, leading to a price war between landlords desperate to fill their properties. The discount wars have started. Landlords are offering 2 weeks free rent. They're offering to pay for electricity, for gas, for Foxtel, Netflix, you name it. Anything, just to get someone in. It should be a golden time for tenants to obtain a cheap lease, but very few people are moving in, with inspections often stymied by concerns about viewers coming through properties during the public health scare. Inquiry rates about rentals are down 80%, Gilmovich said. Hits are very low, very low. People just aren't moving. And Louis Christopher of SQM Research said it was pretty evident that there was a recession in the housing rental market, and one of the main causes was a fall in net migration thanks to the lockdown. The Australian Bureau of Statistics said on Tuesday 538,000 people came to live in Australia in the year to June 2019, while 298,000 went the other way, a net gain of 240,000. But the COVID-19 lockdown and border closure means that the number of immigrants will plummet, posing a clear and present danger to the housing market and broader economy. Christopher said the bulk of population growth is from overseas migration, and that has effectively been frozen. It's come to a screeching halt. And the chief economist at CommSec, Craig James, said in the note on Tuesday that he expected 240,000 fewer people would settle in Australia this year. Clearly, fewer people living here affects consumer spending for a raft of items, impacts the job market, and also has broad effects on the housing sector, he said. The longer that our borders are closed, the greater the risk that Australia will experience a slower economic rebound than other countries without the same reliance on migration. My modelling and analysis suggests that prices will continue to fall for some time yet, as we've discussed many times already. Meantime, the Australian Securities Investment Commission has cautioned lenders not to make too many assumptions about how quickly consumers' income will recover post-pandemic when making loan application assessments. ASIC has published a letter it sent to the Australian Banking Association in response to a series of questions from the ABA about the regulatory approach to lending during the COVID-19 crisis. The ABA is looking to give its members guidance on a range of issues, including the application of responsible lending rules when granting customers relief, the credit code, hardship rules, electronic execution of documents, and disrupted property settlements. 3 weeks ago, ABA CEO Anna Bligh wrote to ASIC and asked whether it was reasonable in meeting responsible lending obligations for lenders to make the following assumptions: that the income of employees and small business operators adversely affected by economic conditions is likely to recover within a reasonable period after restrictions are removed, that any deterioration in asset values during the pandemic is unlikely to be permanent, and that a borrower's requirements and objectives relating to their COVID-19 impacted financial position are likely to be a prominent consideration in meeting responsible lending obligations. In response, ASIC said, "We note that consumers' income is a key consideration affecting capacity to meet financial obligations. The position outlined by the ABA makes the assumptions about a consumer's income without any regard to the consumer's actual circumstances, which may indicate that such a recovery is more likely or less likely. While we agree that ensuring the ongoing flow of affordable credit is important, it's also important that provision of new credit is not based upon assumed changes where these are unlikely to be met and which will result in unmanageable debt burdens for consumers." Good on ASIC, because there will be many people who will hope to get credit but probably shouldn't get credit. And from the US came more bad news, with real gross domestic product decreasing at an annual rate of 4.8% in the first quarter of 2020, according to the advanced estimate released by the Bureau of Economic Analysis. In the fourth quarter of 2019, real GDP increased 2.1%, and the GDP estimate released today is based on source data that is incomplete or subject to further revision by the source agency. The second estimate for the first quarter, based on more complete data, will be released on May the 28th. The decrease in the real GDP in the first quarter reflected negative contributions from personal consumption expenditure, non-residential fixed investment, exports, and private inventory investment that were partly offset by positive contributions from residential fixed investment, federal government spending, and state and local government spending. Imports, which are a subtraction to the calculation of GDP, decreased. The decrease in PCE reflected decreases in services led by healthcare and goods led by motor vehicles and parts. The decrease in non-residential fixed investment primarily reflected a decrease in equipment led by transportation equipment. The decrease in exports primarily reflected a decrease in services led by travel. Current account GDP decreased 3.5%, or $191.2 billion, in the first quarter, to a level of $21.54 trillion. The price index for gross domestic purchases increased 1.6% in the first quarter, compared with an increase of 1.4% in the fourth quarter. And I'm afraid to say that the US economy will look even worse in the next quarter. And finally, Chinese scientists say the novel coronavirus will not be eradicated, adding to a growing consensus around the world that the pathogen will likely return in waves like the flu. It's unlikely the new virus will disappear in a way its close cousin SARS did 17 years ago, as it infects some people without causing obvious symptoms or fever. This group of so-called asymptomatic carriers makes it hard to fully contain transmission, as they can spread the virus undetected. A group of Chinese viral and medical researchers told reporters in Beijing on Monday. With SARS, those infected became seriously ill. Once they were quarantined from others, the virus stopped spreading. In contrast, China is still finding dozens of asymptomatic cases of the virus every day, despite bringing its epidemic under control. This is very likely to be an epidemic that coexists with humans for a long time, becomes seasonal, and is sustained within human bodies. So that really does beg the question, doesn't it? if in fact this is going to be something which continues to rage on and off for many years, then the strategy of a complete lockdown is hard to countenance. On the other hand, if it is conceivable that the virus can be stamped out, well then maybe things are not quite as serious as that. And I have to say that Australia is quite well positioned now, with only a very small number of cases. But I also think that the pressure to open up the economy, not just here but around the world, will be in contention with those who still prefer to lock down for further periods of time to try and stamp the virus out. The bottom line is, we actually don't know. We don't know enough about the virus. We don't know enough about the way it's going to behave. In the meantime, what we do know is that the economic damage continues to rage. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.